It's down now. We may want to take some money from the safe side and put it in the market because of the safe risk ratios off.
Mm-hmm.
Okay. It depends on when you get in the market too. Like people that have been in the market a long time are up.
Right.
They're up. So even this little blip down, they're still way up if they're 10 years in or whatever.
Sure.
But for the little old lady that had her CD come due in January, and the banker had them put it in a growth fund or balance fund, that little old lady that's not used to losing money in her 1% CD is now down 10-15%.
Mm-hmm.
That's the bad stuff.
Right.
Those people, they truly are feeling pain mentally, and I could see why, because they were never market investors. CD rates were so low, they just had to do something to get better than a CD rate.
Sure.
So they get in at the worst time and they take a beating, and then they're ruined forever.
Wow. Right.
You know what I mean? They're like, why'd I do that? I'm never doing it again.
Right.
Welcome to Today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Anchored in family values, Wayne offers practical advice to help you get the most out of your retirement years. For more information, visit today'sretirees.com. Now, here's your host.
Welcome to Today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. So, here we are looking at the stock market, looking at the turmoil in the financial world. The Federal Reserve decided to raise interest rates. How come, by the way, that when they raise interest rates, my savings account doesn't change?
It should be changing.
It should be?
I mean, there's a lag.
Was it like 10-year lag?
No, I mean, like we have annuities that are tied to, the Fed, and those rates are already getting bumped.
Okay, well that's good news.
Yeah.
If you are in that world,
Mm-hmm.
but it's you talk to folks, and you send out. By the way, Wayne has a really good newsletter, and you need to go to Wayne's website, today'sretirees.com. You can sign up for that newsletter. But you wrote a little bit just a few days ago. I was reading it. The stock market's down, 20% overall in the last 6 months?
Give or take, yes.
Everybody's into the crypto stuff, and it's down, 50, 60%?
Mm-hmm.
Some of that stuff is. So, I mean, overall, if you've been in it for a while, you're probably okay. But still,
Mm-hmm.
when you hit sections like this, and you've talked about this for years,
Mm-hmm.
I don't know if this is a real correction, but it could be a big hit for some folks.
Yeah, I mean, it's going to be a big hit for those that have equities in the market.
Mm-hmm.
You're going to feel pain when the market pulls back. And we won't know if this is the correction for the year until it's over.
Mm-hmm.
It could keep going lower than it is right now.
Sure.
We talked about in previous shows how in an off-presidential election year,
Right.
when the year started out down in January, typically was very rocky road with a health restoring correction. And it appears that's what we're in the middle of. So history tends to repeat itself. But in those scenarios, like since World War II, when these off-presidential election years have happened, the market wounded up an average of 4% after all the
roller coaster, It still ended up 4%.
By year end,
Okay.
as an average.
Sure.
As an average.
Yeah, I mean, and that's you're not making predictions here because we're not prophets, but we look at history.
Mm-hmm.
But
That's all we got to go on
and
when it comes to the market.
right, but I would think, especially because we're talking mainly with retirees and those that are near retirees. You take a 20 or 25% hit in your portfolio, if that's the right word. For some folks, that could be some sleepless nights.
And, that's one of the things I want to talk about in today's show. If it's going to be some sleepless nights, then they shouldn't be in the market to that extent. I mean, what do they think the market's going to do over time? Go up forever?
Right. Right. Well, but for the last, 20 years, other than a couple of blips in 08, 09.
Well, early 2000s, we had 3 years in a row down.
Okay.
50% drop. 2008, we had the pullback. Then we had COVID, March of COVID year, had a nice pullback. All rebounded quickly. So people are kind of getting spoiled. That's not historically how the market works over the last 100 years.
Sure.
I mean, there's a period from the mid-60s to the early to mid-90s, about 30 years, where the market had a pullback in the 60s and never caught back to where it was until the mid-90s.
Wow, 30 years.
It's a 30-year time frame.
30 years to get back to where it started.
Correct.
Wow.
Correct. People forget that stuff.
Okay.
And they get spoiled, especially the last 3 years before this year. Market's up nice 3 years in a row. Everyone's making money that's in the market. But when the market has a pullback and you're feeling double-digit pain, you should expect that to happen. You should know it will happen at some point.
Sure.
If you're in the market long enough.
Right.
And if you're getting antsy or losing sleep, or worse yet, get out of the market when it's down 20%, then you're the type of person that shouldn't be in the market.
Well, we've talked about this on this show for the last several years, and I've asked you this question. How many calls have you received for folks who are antsy or anxious?
Yeah.
And most of the time you tell me very, very few.
Very little. Very little. One or two. I think I met with someone this last week that, thinking about getting out, and which is their prerogative to get out.
Sure.
Client tells me, get me out of this thing, But the terrible part about that is I just know we're never going to get it back or get it back quick enough. So, you can't ride it down and then get out and, think you're going to time it to get back in at the right time.
Sure.
And if you stay out of the market for good, you're just never going to get that money back.
Right. And you have told me in times past that if they will follow sage advice, they're protected pretty well.
Yeah, I mean, when we lay out safe risk ratios with clients, one's money shouldn't all be at risk. You should have safety with some of your money. Safety in accounts that don't go backwards and beat or stay ahead of inflation. And then you could take risk with some of your money. And then with that risk, how risky do you want to be? You have to lay all that out. You have to look at the potential loss of whatever the portfolio can lose. Like my balanced portfolio should, you have to be able to take a 25% or so loss. If you can't do that, then you shouldn't be in it.
Sure.
And I tell them that up front.
Right.
And I tell them that if we shouldn't be in this because you can't take that kind of loss, but you're in it, you got to wait for the market to recover, and then you change things up. You just don't want to do it when it's on the downturn. Right.
You don't. Otherwise, you can be making some big mistakes. And we're going to take a quick break. We'll be back right after this. As I said earlier, go to Wayne's website, todaysretirees.com, todaysretirees.com. If you're feeling a little anxious, maybe you need to get someone to take a second look at what you're doing for your family finances. Wayne is available for that as well at 866-626-3990. We'll be back right after this.
We've all heard the word rollover when referring to an investment account at work or your 401k, your 403b, your 457 plan. What do you do with that when you've left your job and your 401k or other retirement plan is still at your old employer? Or what if you've retired? One thing you don't want to do is you don't want to leave your money, your retirement account, in your employer's 401k. Quite frankly, your old employer or current employer is the boss of your retirement account. So if you have questions about what to do with your rollover, you roll it to Wayne. Get it in your own hands where you have the whole universe of investments and choices, not just what your employer tells you can pick from. So contact my office for a free consultation on how to roll over your old retirement account.
And welcome back to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Right now, it's kind of a rocky time in the financial markets around the world, especially in America. And one of the things that we were talking about earlier, Wayne, and I didn't know this mid-60s to mid-90s, it took 30 years to recover what was lost in the 60s?
Yeah, not just the 60s, but the whole trough down into the 80s, and then finally got back to where it was in the mid-90s.
Wow.
Right before the tech boom.
So those folks that were invested in that time period, pre-fall in the 1960s, they had to wait 30 years just to break even.
For the index to come back.
Okay.
Yeah, now if they were taking their dividends and reinvesting in stocks and stuff, it wasn't as ugly for them because they're getting dividend and payouts that they're reinvesting or putting somewhere else, but just the price of the index itself.
Okay.
Yeah.
So do the financial gurus, could we see this again? I guess is my question.
Oh, anything could happen. Sure. Yeah, of course.
So
absolutely. I mean, that was, a lot was going on then, right, politically?
Oh, yeah.
So, and then we had inflation, ironically, with Carter, and recessions and Vietnam Wars. And so, you just don't know, and people forget that. And when you look at all of the ups and downs historically, what we've been going through over the last, say, 13 years has been pretty much unprecedented, really. It's a long time for us not to have a true market correction.
Okay.
Normally it's 6, 7, 8 years.
And those market corrections are what, anywhere from 10 to 20%?
Or more.
Or more? Wow.
Yeah, I think the experts say an official correction would be what, like high teens, 20% or more.
Okay. Which is where we are now.
Which is where we're getting there. Yeah, we're about right there.
I mean, as far as the entire market size of that.
We still don't know if it's over, though.
Right. Yeah, because we're in the midst of it. Now, this takes me back to what we've talked about here many times, and as we discussed in our prior segment, risk, safe, all of these kinds of different setups. But it comes down to really a sound plan that you are comfortable with for your family. Or
that you felt you were comfortable with.
Okay.
So if you're feeling the pain, if you're thinking about it, if you're thinking of getting out, if you're wondering why you took too much risk, if you're losing sleep, looking at it every day, oh, we're down again. You get your monthly statement, you're down however much, 10, 20,000, and you're like, oh my gosh, you pretty much failed the test. Okay, you thought you could take more risks than you can.
Sure.
So the test has failed.
All right.
People that know how the market works and lay out their safe risk money and take the proper amount of risk, whatever happens when the market pulls back, they take it with a grain of salt.
Okay.
They don't even think about it because they know it's going to happen. They know what's going to happen to their money when it happens, and they just go with the flow. And some might be like, well, that dropped a little more than I wanted, so once the market corrects, we'll tone that portion down a little bit.
Okay.
Or they just kind of analyze through the loss that their portfolio took. The good news about failing this test is the market historically rebounds.
Sure.
right? So once it rebounds, it's like a do-over.
Okay.
Like you failed the test, teacher says, I'm going to give you another shot.
Right.
So now go study more. In this case, go rearrange your money more properly assigned or aligned with your money values.
Okay.
And let's try this again for the next pullback.
Right.
Right? And so you have to be able to take the loss.
Sure.
And not only mentally, and not only you, but your spouse, but also for retirement and retirement income.
Mm-hmm.
You don't want a big market loss messing up your cash flow.
Sure.
Or your dreams or your bucket list stuff.
Mm-hmm.
So, it's important to do the homework and then to ultimately get your money to where it mostly makes sense.
Mm-hmm.
And that's, of course, what I help people do. But even all the legwork we do and all the meetings, it's not one or two meetings.
Right.
It's 5, 6, 7 meetings before we figure out where to put the money. There's a lot of legwork that has to go into dialing in to the right investment allocations and setup. So, but sometimes the people get it wrong.
Mm-hmm.
They'll say, yeah, I could take that. I think I can handle that if the market corrected. And then when the market corrects, I get the call.
Right.
There's not a lot. We have hundreds and hundreds and hundreds of clients, and we get a couple calls when this stuff happens.
Sure.
Or people schedule a meeting to come in and review and just see what the deal is.
Right. Well, I guess as I'm listening to this, when we set this up for this, let's say I can, I'm in your balance fund and you're saying, you have to be able to take a 20 or 25% pullback. Mm-hmm. And I think I can do that. Mm-hmm. And then it happens, and like you say, I lose $10,000 or $20,000 or whatever it is.
So on $100,000, you'd be down to 75.
Sure. So at that point, I would think that over the last decade or so, we've seen, the averages, almost on the first hill of the roller coaster. Mm-hmm. I mean, it's been pretty going along pretty well. Mm-hmm. So when it does this, and you sit down with these folks, when you rebalance, or is that something that you should just do regularly anyway?
Sometimes we rebalance. I don't automatically do it.
Maybe I used the wrong word there, but
like a lot of people do. When you have a safe risk ratio, you should balance that through the years as you get older.
Okay.
Because say your market money may grow at an extent that's faster than the safe money, right? Like the last 3 years. Mm-hmm. Well, that's going to take your ratio out of whack. So you should take profits and get them safe if you're going to keep the same safe risk ratio.
Sure.
The opposite might be also true. Market's down now. We may want to take some money from the safe side and put it in the market because of the safe risk ratio's off.
Mm-hmm.
Okay. It depends on when you get in the market too. Like people that have been in the market a long time are up.
Right.
They're up. So even this little blip down, they're still way up if they're 10 years in or whatever.
Sure.
But for the little old lady that had her CD come due in January, and the banker had them put it in a growth fund or balance fund, that little old lady that's not used to losing money in her 1% CD is now down 10, 15%.
Mm-hmm.
That's the bad stuff.
Right.
Those people, they truly are feeling pain mentally, and I could see why, because they were never market investors. CD rates were so low, they just had to do something to get better than a CD rate.
Sure.
So they get in at the worst time, and they take a beating, and then they're ruined forever.
Wow. Right.
You know what I mean? They're like, why'd I do that? I'm never doing it again.
Right. And that's why you need a sound financial plan. That's why you need to work with someone like Wayne, certified financial planner at Great Lakes Benefits and Wealth Management. Go to his website, todaysretirees.com, todaysretirees.com. We'll be back right after this.
A certified financial planner is a true professional, a well-rounded, holistic planner that helps you in all areas of your financial life. Estate planning, tax planning, financial planning, insurance planning. We have to sit for a 10-hour, 2-day exam at least back when I took the test. It's not just a weekend designation where you go somewhere for a couple days, pay a couple $100, and now you have letters behind your name. One thing I think is important is that you try and find a independent certified financial planner. Somebody that doesn't work for a big firm. I myself own my company, Great Lakes Benefits and Wealth Management. The buck stops with me, an independent, certified financial planner, one of the only ones on the north coast of Ohio.
And welcome back to today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Today's program, we are talking about a test. Did you pass the test? Some folks didn't pass the test, did they, Wayne?
No, I mean, some, most of my clients, probably 9% of them, they pass the test because they've been through it, they know what to expect.
Mm-hmm.
But even some of those that didn't, you have to go back and talk with them and say, why? What changed?
Sure.
This was not an issue before. What is happening in your thoughts, in your life, as to why it matters now?
Mm-hmm.
Then you got to figure, well, they'll say they're older. Well, I'm older now. And that's good. Well, then we were older when we talked about this stuff. We should have toned down the risk if you couldn't take that kind of loss.
Mm-hmm.
So we made a mistake. We missed it. So when the market rebounds, let's tone it down a bit.
Mm-hmm.
Or we find out, let's just say you didn't lose this money. What would you be doing with it? Say your $300,000's down, 50 grand. What would you be doing different if it was still at 300,000?
Mm-hmm.
Would your lifestyle be changing at all, or are you just worrying because it's down, for no reason?
Right.
Are we needing this money to live off of? Well, no. So then what are you worrying about?
Right.
Well, I just see it going down. So you got to kind of talk them through that, and then you got to ask people, okay, you're nervous now. What do you think is going to happen moving forward to the market?
Sure. That was my next question. Yeah. Where do we go from here?
Where do we go from here?
Yeah.
It's going to go up or it's going to go down. You got to be good with either way.
Mm-hmm.
You got to be good where if this market continues to go down, your financial plan is going to be okay.
Mm-hmm. And that's tough for some folks, and that's what you try to figure out for the family, is whether they can continue to take as much risk as they are, or how do they balance that going forward?
That's done early on. I mean, pretty much, I'm not going to have someone take too much risk to where it's going to mess up their goals.
Sure. Okay.
So that's almost a never have to do a midstream change.
Mm-hmm.
If we put something together, it's going to be ironclad.
Mm-hmm.
Unless they do something stupid, start buying a ridiculous amount of toys or a big rental or a big new house they didn't say they wanted to do, or
right.
you bought a risky investment or went into business with someone and it failed. Stuff like that could mess it up. A general financial plan, once we get through the legwork, it's not going to fail. Mm-hmm. Unless they change gears.
Okay. So looking down the road, the financial prognosticators, we don't know where this is going to go. But our plan, if we did it right, should be sound to weather the storm, whether it's a good storm, if there is such a thing, mm-hmm. or if it's a tornado.
Yeah, I mean, whether it goes down further and lasts longer, or whether it recuperates. I mean, in my investment letters that I write to my clients that have investments with me, even though the market was expected to be down with a lot of volatility because of the off-presidential election year, that I wrote in there the market should still be up,
mm-hmm.
Over 5,000 points by the end of the year.
Okay.
So that's my prediction. And it's not just my financial prowess, it's the people I follow and trust.
Mm-hmm.
And we're looking at a 5,000 S&P.
Okay. So
it's at 4,000 today.
So based on those thoughts,
Mm-hmm.
And I'm that guy or that family that has taken the little bit of a risk, in your balanced portfolio, and maybe I'm down 20 or 25%, is now the time to say, well, I've got a little extra money. Is this a buyer's market? I should maybe put a little more in there?
Absolutely.
So if you have a little extra for whatever reason?
Well, the market was at 4,800 points a handful of months ago.
Mm-hmm.
The S&P. It's at 4,000 points right now.
Okay.
Would you rather buy in at 48 or 40 for 4,000?
Right. It's like it's on sale almost.
It's on sale. Now, we don't know if it's a bargain basement sale yet.
Yeah.
We start getting the S&P into the mid threes, 3,500 or so.
Mm-hmm.
I mean, I would potentially look at going all in with all of your available cash at that point. But we got to see if it gets there.
Wow. There you go. So
That's when you start maybe mortgaging the house and throwing it into the market.
but that would be foolishness.
Yeah.
And that's
Unless
what.
you have nerves of steel.
Yeah.
Yeah, for some people.
Or you want to stay married.
Right. Kind of being facetious, but
Right.
it has worked out for people in the past during big market corrections.
Right. But those are almost like throwing the dice. I mean, your portfolios that you put together for folks and your financial plans, there's risk there to a little bit, but you put this plan together that makes sense so that they can weather whatever risk is there, and they're not destitute when it's over.
Right.
I
I mean, even business owners, and I certainly don't recommend taking money out on your house to invest in the market, but, I would have to say many, if not most, business owners and entrepreneurs have mortgaged their home to keep their payroll going and invest in the business and, pay their rent or build their building for their business. So it's not much different if you're familiar with the stocks you're going to mortgage.
Sure.
I'm just saying, if stocks ever get to bargain basement,
Right.
and you're familiar with the companies, and I'm not suggesting doing it, but there are people it would make sense for
Right.
that have nerves of steel.
Yeah, that's not me.
And it's not me either.
Well, friends, that's all the time that we have for this episode of Today's Retirees. Take the time and go to Wayne's website at todaysretirees.com or give him a call at 866-626-3990. We'll see you the next time.
Thanks for tuning in to Today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Visit todaysretirees.com or call 866-626-3990 to schedule a no-cost appointment with Wayne. Today's Retirees is brought to you by Great Lakes Benefits and Wealth Management, family-focused retirement and tax planning services, anchored in family values. Information and opinions discussed on Today's Retirees do not necessarily reflect the opinions of this station. Opinions expressed should not be substituted for individualized consultation with a qualified financial advisor. For specific information, call 866-626-3990 or visit todaysretirees.com.